Hi friends, welcome to quarter 2 episode of Commodities and Currency Monitor. We have with us our Commodities and Currency Analyst Riya Singh. Welcome Riya.
Thank you.
So Riya, given the rupee's recent weakness against dollar and RBI's limited intervention, what's your outlook on INR for next 6 to 12 months?
So, like you said, Indian Rupee has been on the depreciation momentum. It has already corrected around 3.9% for the year. And I think the major reason behind this depreciation has been the pressure that has been put by the US. So we have elevated US tariffs. Apart from that, if you look at the confidence that it has triggered for the FII. So we are seeing a lot of FII outflows as well. So for the past 3 months, FII outflows has crossed 60,000 crores. So that is again putting pressure on the Indian rupee. Recently, the hike in the H1B visas. So this is again a negative that has been impacting the Indian currencies. So all these factors have definitely put a dent on us on the home currency strength. Even if you look at our import-export numbers, so we could clearly see the impact of the US tariffs in those numbers and on our trade deficit as well. So whether this depreciation rally will continue, it will depend a lot on how these tariffs progress going forward, whether these tariffs will have a rollback or more addition tariffs could be levied. We are amidst a lot of uncertainties around that path. There are news that US again can put additional tariffs on the pharma companies and even on other imports that they are doing. So I think if these, even if the present situations continue for at least like 3 to 4 months, it could push the rupee towards 89-90 levels. For the rupee to have a appreciative momentum, US tariffs has to get lower. Some middle ground needs to be achieved between US and India trade negotiations and so forth. Right now, only support that is being lent is a strong rural consumer numbers and domestic demand. I think GST rate cut is a very positive step in supporting the domestic demand. Yeah. So when coming on the RBI, even if you look at the RBI actions, I think they have been very limited and selective. We are not seeing RBI currently defending any particular level like we have seen in the previous months. So I think right now if you look at the momentum around 88.50, some action I think is being felt that they have done, but otherwise, they have led the Indian rupee to find its own footing, and this is also one of the reasons why we have seen such a drastic depreciation in the Indian rupee. So we are looking forward some positive numbers that could work in the favor. But like I said, unless these tariffs come down, the pressure on the Indian rupee will continue.
The uncertainty,
yes,
that is the devil.
Yeah.
Correct. So given the US economy's mixed signals with slowing labor market momentum, resilient consumption and inflation remaining above the Fed's 2% target, how do you see US dollar performing?
So if you look at the US dollar, so even the US index have corrected quite a bit. So from 108, it has now come down to around trading at around 97, 98 levels. So this has happened because Fed has started its easing cycle. We have seen rate cuts and the policy rate coming down to 4.25%. Apart from that, market is already pricing in 3 more rate cuts for the year. So this dovish pivot has put a pressure on the dollar index. Apart from that, like you said, the uncertainties in the US economy continues, where the Fed is going for an easing cycle. Core inflation remains sticky at 3%. So they have to do quite a balancing act where they have to aid the economy with the easing policies as well as maintain a 3% or lower, or get the inflation towards the 2% target. considering the US tariffs.
Right.
So obviously it will be a very hard play going forward. Then of course we also have US government going for a shutdown today.
Yes.
Because of the spending bills. So if that happens, we will not get a lot of numbers, which are very important in factoring in what the coming projections could be for the dollar index. Even Fed looks at the labor numbers. So we are seeing quite a slowdown into the labor numbers as well. The revision in the unemployment claims is one of the signals that there is a slowdown into the labor growth. So I think if the US shutdowns, it will definitely put more pressure on the US labor market, because whenever these things happens, a lot of federal workers go on a furlough. So around 750,000 federal workers are estimated to go on a furlough once the US government comes to a shutdowns today. So I think this will definitely, these developments that are there are putting pressure on the dollar index. What could work in the favor is the one positive number which is coming out is US GDP numbers, which has, from negative territory has shifted to a positive one. So if in the future the easing cycles seeps into the economy and supports the domestic growth, I think that could push the dollar index on the higher side. But right now I think for at least a month or so, unless some development happens, you could see dollar index trading below 100.
Sure. With ongoing OPEC plus supply decisions, rising US crude production, and Russia maintaining high export levels to Asia, what is your outlook for global oil markets, and what are the key factors likely to influence crude prices?
So crude oil prices have been battered with a lot of oversupply, news, and of course we have seen production being released by the OPEC, which they had hold of considering the prices. Even now OPEC is considering to release around 500k barrels per day, obviously in a staggered way, but even if those production comes into, or those kind of supply comes into the market, it will create an oversupply, because at this time even the US is producing more than 30.5 million barrels per day. India and China continues to import from Russia. So I think if you look at the projections by IEA, so they are indicating that market could be in a surplus at around 3.3 million barrels per day in 2026. So all these factors are creating a bearish pressure. But if you look at the prices, they have been quite supportive, around $61, $62 on the WTI. Because China has been taking up a lot of reserves, building up reserves, oil reserves, considering the heat that they had taken when the Russian and Ukraine war had started and there was a supply chain disruption. So during these time, right now, the prices are supportive because a lot of these supplies are being taken up by China. But obviously if the supply continues to come into the market and at some point China will slow down the buying, then we could see prices falling further. But right now I think it will be supportive around the current trading levels.
Correct. We have to see how the demand supply balance plays out.
Yes, definitely.
And everybody, all the oil producers are looking out for their own interests.
Yes, then there is also non-OPEC suppliers which are not actually complying with their the setup that the OPEC has, the target that OPEC has given to them. So.
Correct. So far OPEC was balancing their own interests, but now with more oil producers coming into picture, everybody will look out for their own interests. So it will be interesting to see how that plays out.
Definitely.
So how will the EU's acceleration of its Russian LNG ban and increase in the US gas output affect global LNG trade flows and pricing over the next year?
So natural gas market has been very interesting because, like you said, EU wants to divert its import from Russia to some non-Russian supply. So if you look at the numbers itself, they have, I think, shifted around 70% of their supply, and the major supply they have been taking is from US. So if you look at the import numbers, the Russian NG import for Europe has come down from 21% to around 14%. On the same side, if you look at the numbers from the US, so they have the numbers have climbed from around 15% to 54% when it comes to importing the US LNG. But on the same side, because a lot of push is there to stop reliance or stop importing the Russian LNG, the competition for non-Russian LNG is becoming quite competitive. So this will keep volatility into the prices. So if you look at the current prices of Henry Hub gas, so they are trading at around $3.44. So if you compare it to the previous year on year, it is trading at around 64% higher. So this is itself indicating the competition for non-LNG supply that is there into the market. It also creates a risk if something happens to the US supply. It could create a lot of price pressure onto the gas into the market. So yes, I think it is a good step, but I think Europe has to divert or keep more countries into its basket when it comes to importing rather than just importing US LNG. Yeah, so I think it will, for now, these scenarios which is erupting, it could keep prices for Henry Hub gas supportive, and even I think in the peak season it could surpass $4.
Correct. And we have to see how far their morality encompasses to Russia buying Russian LNG as well.
Yes, I think when the demand hits and the reserves falls, any country will be more interested in getting the energy security rather than playing along the lines whether they want to import Russian gas or not. So if the winters hit more harsh and US supply is not sufficient enough, I think the target that they have set to completely come off the Russian LNG till 2027, I think it could extend.
Right. Let's move towards the hot favorite asset class, gold. Gold has held steady as a safe haven asset in times of uncertainty. What macroeconomic factors drive gold prices to consolidate near record highs?
So I think the previous rallies in gold, when these war situations started, I think the major thing that triggered the rally was the aggressive central bank buying. So once Russian gold got freezed, so it triggered a lot of countries to start building up its own reserve in the country itself, and we saw quite a rush to accumulate gold by the central bank. So the previous rallies was quite pushed by the central bankers. Now for the past few months, if you look at the central bank purchases, they have slowed down a bit because obviously the prices have climbed so much.
Other than China probably.
Yes. Yes, China is, the physical market is trading somewhat in discount, but other than that, I think they have also opened up the market to for the fund managers to have some kind of, some allocation into the gold and silver asset as well. But right now, if you look at, like I said, a lot of flows into ETFs are coming. So ETF flows have itself accounted for around 212 tons in the first half of 2025, which is massive. Then we are seeing a lot of positivity coming into looking gold as a safe haven and also as an hedge to your current portfolio. So I think a lot of people have started looking or started investing into the gold, which has aided the rally. If you look at the US dollar, that has sunk quite a bit from 108 to 97 and 98. So this has also pushed a lot of flows to come to gold. The US Treasury yields are trading lower. So when the yields are lower, the US Treasuries becomes very less attractive as an investment. So again, the flows get diverted to a better safe haven assets. So these all factors are something that have triggered quite a rally. Then a lot of uncertainties in the US economy, the tariff outlay which is happening right now. So none of the economies is quite safe. Otherwise, whenever there was uncertainty, people used to flock to US. Or when the uncertainties came down, then again the developing or emerging markets became very attractive. But these risk on risk off is something which is not happening right now. People have been the markets have been on their toes. Then going forward, I think a lot of central bankers are on the easing cycle. So this also makes gold, the bullions very attractive. So I think if you look at the market right now, the prices I think will range between 3,500 to 3,800 right now, because 3,800 will act as a very important resistance. If it crosses beyond that, then obviously we'll see more prices rallying towards $4,000 also. So I think going forward, I am not seeing any reversal right now. The prices has to come down below 3,500 to actually see some reversal into gold. But otherwise, short profit taking might happen, but the trend still remains quite bullish for gold.
Yeah, and we are seeing in India as well that people are moving away from just buying jewelry as investment and moving towards gold ETFs. So that's a welcome
very much
development and
yes.
Good way to participate in the rally. Silver has outpaced gold this quarter. What supply and demand dynamics have led to this breakout performance above $48 per ounce? And do you anticipate this trend sustaining in Q4? How should investors balance gold versus silver exposure?
So I think if you look at gold, it has been on the bullish trend, but for the silver to achieve a bullish trend, it took 15 years. So we saw it in the rally in 2011, and then there was quite a bit correction, taking the gold silver prices from $50 to $11. So for 15 years, there have been a supportive bullish buying that has been happening into the silver. So I will say that the momentum into the silver is quite strong as compared to what we saw in 2011, because it took so much time for the prices to finally come or test even near to the previous highs. Even if you look like similarly to gold, ETFs in silver has also been garnering a lot of interest. In India itself, we saw the flows coming into the ETF. So in around 2022, it was around the flows were for 2 million ounces. And if you look at the current numbers, it has increased to 58 million ounces. So I think this itself is triggering a lot of demand for silver. Going forward, if you look at the gold and silver ratio, so it has come down from 106 to near 80. So 80 is the average for gold and silver ratio. I think if the prices in gold climbs further to $4,000, we will see another rally happening into the silver itself. So even if you look at the technical aspect of, talking to the technical in terms of technical charting, if you look at the monthly chart of silver, there is a rounding bottom that is being formed. So if you look from 2011 to right now, so the gap that the rounding or the spread of this chart pattern is around $65. So if you just add to the breakout, it gives you a target of $85. So there is still space for silver to rally. There is more $3 to go to test its highs. So $50 is becoming a psychological ceiling into silver. If it surpasses that and sustains it, then we could see another leg commencing into the silver going forward. And the industrial aspect remains quite lucrative. If you look at the silver it is already into deficit. The raw material, the supply is already into deficit. Then the silver recycling climbs up, but when it comes to the technological part, it does not retain the same quality or the same performance that the copper does. So the demand for the silver into when it comes to the tech part, it will continue to rise. So going forward, I think the lot of demand for the silver will emerge from tech, from to EV to this ETFs, because as compared to gold, silver will still be very lucrative to get into, and even as an investment purpose, or even getting the physical investment. So I think going forward, 50, like I said, $50 will be a very psychological resistance into the silver. Once it gives a breakout, it will continue its leg towards $65 to $85.
Oh, that's great. And of course, our equity research team has released a lot of reports on how that applies into specific companies and how it affects the stock prices. So do tune in for that as well. Thank you for the great insights, Riya. Thank you for tuning in, everybody, and like, share, subscribe. Thank you.